At the beginning of this week, I put 4 stocks in front of you and asked you one simple question: hold or break? And I put 3 defense stocks in front of you and told you exactly what levels matter and exactly what to watch for. Well, the market answered. And some of these answers are going to surprise you. Some of them are going to validate exactly what the charts were telling us. And one of them is sending a warning signal that you absolutely can't ignore right now. This is the midweek check-in. Let's go through every single one. All right, buddy, welcome back to Chart After Dark. I'm Guhan Al-Ghazli. If you're new here, where have you been? This is where we read price, identify levels, and let the market prove us right or wrong in real time. No guessing, no hopio, just charts. Before we dive in, if you've been following along since Monday, first of all, thank you. Second, hit the subscribe button, would you, right now if you haven't already? Because this midweek accountability format, we're making this a regular thing. You want to be here for it? Share this video with one trader in your life who needs to see how real technical analysis actually works in real time. All right, let's get into it. So we're going to start off with Duolingo. Look at the weekly chart. It was $100 then. It's now at $96.17. So because this one's painful to look at, and I mean that in a most technically honest way possible, when I first brought this to you, price had come all the way back down to that $101 zone. Prior structure, former support before the big move higher. And I asked you, or break. Well, look at what happened. It's broke. Cleanly, no hesitation, price sliced through that level and is now sitting at $96.17. And when I zoom out on this weekly chart, I want you to really take in what you're looking at. This stock was trading north of $500 not long ago. It's now approaching a level that goes all the way back to where this whole thing started. That long-term horizontal support zone sitting around $95 to $100 area, which you can see I've had marked for a while now. Here's the brutal reality of what this chart's telling us. Every rally attempt has been sold. Every bounce has been a trap. The structure of this chart is a distribution structure. High and lower level, and now a waterfall. And we are now right at the last meaningful floor, before this thing potentially has no technical memory below it for a very, very long time. So what do you do with this information? You don't panic buy a falling knife because it looks cheap. You wait, you watch. Does $95 produce a weekly reversal candle with real follow through? If yes, that's your first signal to start paying attention to the long side. If it breaks, the chart goes dark. There's very little structure below that level. For the people who called break in the comments, you read that one right. Okay, stock 2, SAP. It was $200, and we're now looking at $195.58. So this one, I want you to really study carefully. When I brought this to you, price was leaning into a former breakout zone, that $200 to $201 area. That used to be resistance. Old resistance revisited from above. The classic question, does it now act as support? The answer this week, not convincingly, price is at $195.58 right now. It dipped below that zone, tested lower, hit $187.94 intraday at the low this week. It has bounced back somewhat, but we're not out of the woods, not even close. So look at this weekly chart from the beginning. SAP had a beautiful, almost perfect uptrend from 2023 all the way into mid-2025. Then it peaked, and the sell-off has been relentless. Now, there are 2 levels on this chart that matter. The first is that $195 to $200 zone, which price is dancing around right now. And second, this is the one that should concern anyone holding the stock. You have a deeper support level down around 180. That's the next real floor if 195 doesn't hold. So what I'm watching for is a weekly close back above $200 and start to rehabilitate this chart. A weekly close below $187 accelerates the case for a move down to 180. Right now, we're in no man's land, and in no man's land, patience is the only trade. All right. Let's look at our third stock, Oklo. It was then around $62, $63. We're now looking at $65.65. So now here's one where the chart gives you a little hope, and I want to be precise about what a little hope means technically. When we brought Oklo to you, price was sitting right on the $62 to $63 base, former support, a level that had held once before. And I said markets don't always reward repetition. The question was whether buyers would show up again. And so far they have. Barely, but they have. Price is at $65.65 right now, which means we're holding above that base. But here's what I need you to notice. Look at the structure above where we are right now. There's significant resistance zone up around $80 to $90. You can see clearly on this weekly chart, marked right here. That's January's former support before the big collapse, and it's going to act as a ceiling now. So what does the Oklo chart look like to me right now? Well, a potential dead count bounce area unless something changes structurally. The base is holding, that's positive, but the overhead supply between $80 and $90 is enormous. And a rally into that zone is going to face real selling pressure from people who bought there and want out. So for Oklo to become genuinely interesting to the upside, I want to see a weekly close above $90. Until that happens, this is a stock I watch, not line chase. The nuclear energy theme is real, and the long-term story is compelling, but price doesn't care about stories. Price cares about levels and structure. All right, the fourth stock on that list was Oracle. It was $145 then. It's now hovering at about $152.37. And this one's most technically interesting of the four. When I brought Oracle to you, I told you something specific. This isn't just about a horizontal support level. This is about a long-term rising trend line, meeting horizontal memory at about $140 to $145 zone. The trend line plus structure equals compounding support, and I asked whether it would hold. Look at what happened. Price tag that trend line, went right down to it at $141 intraday, and then bounced. Right now, we're at $152.37 and moving higher. That trend line that goes back years, it's held. Now, I'm not declaring victory here because the chart still needs to prove itself. Oracle had one of the most spectacular run-ups I've seen on a weekly chart from around $80 all the way up to $340 at the peak. And that gave a significant portion of that back. The question now is whether this trend line bounce is the beginning of a genuine recovery or just a relief bounce before another leg lower. So what I want to see, Oracle needs to clear the $160 to $165 area on a weekly closing basis to start generating real confidence. Until then, the trend line bounce is constructive but unconfirmed. If it fails back below the trend line, which is now roughly at around $140, $145, that support's gone, and the chart gets ugly fast. For the people who called hold on Oracle, nice call. But keep watching. This story isn't over yet. All right. We're going to move on to part two here, the defense stocks. We're going to check in on that. General Dynamics GD, it was $364.78. It's now hovering at $366.12. So, because earlier this week, I brought you these three defense stocks in the context of the Middle East situation, I wanted to revisit each one, right? Because the charts have moved. General Dynamics, the rising channel, two prior rejections at the upper trend line, March 2022, October 2025. And when I brought it to you, price was pressing right up into this upper channel resistance for a thin time. Well, where are we now? 366. We're still at the top of a channel. Price is not broken out decisively above it, but it also hasn't been rejected hard. So we're essentially pressing against that upper rail. And this week's candle is going to matter enormously. Now, here's what I'm reading. The geopolitical tailwind is real and it's keeping buyers engaged at this level. But the chart has two prior rejections here. The third time is always the most interesting because when a level gets tested three times, one of two things can happen. Either the sellers finally run out of ammunition and price breaks through, or the buyers exhaust themselves trying to push through a wall they can't break, and the rejection is sharp. Channel support is still down around $295 to $300. The upper rail is right where we're trading. This is live. Watch for the weekly close. All right. Northrop Grumman, NOC. That was at about $768. We're now hovering at about $753.84. So This one was one of the most exciting ones when I first presented it because the gap above the multi-decade trend line was one of the most significant structural events I had seen on the chart in a long time. Price had gapped above the trend line that had defined this stock since 2018. It tested twice over the years, held both times, and then blown through on a gap up. Now, where are we? About 753.84. And here's what I want you to notice. After that explosive move, prices pulled back slightly. We came off the highs, and now we're getting the first real test of whether that former trend line, which is now support, is actually going to function as support. This is exactly what I told you to watch for. I said, if you miss the initial move, watch for a pullback into the $700 to $725 gap zone as a potential reentry. We haven't gotten all the way down there, but a pullback is happening. The question is now, how deep does it go before buyers step back in? The structure here remains the most bullish of the three defense names in my view. The trend line held at a support for years. The gap above it is significant. As long as price doesn't fall back below that trend line, roughly around $700 on the weekly, bull case for NOC is intact. All right, third one, RTX Corporation. RTX Raytheon, the one I said was the most directly tied to active geopolitical conflict of any name on the board. When I first brought it to you, price had just gapped above the critical $205 resistance zone on the daily chart. The gap above resistance with a real fundamental catalyst driving it. And I gave you a very specific level of RTX holds above 205, 206. On a closing basis, the target is wide open to the upside. If it fails to hold, the gap fills and price comes back. So here's the honest midweek read. Price is at 208.82. We have held above 205, but look at the daily chart carefully. We had a sharp spike above the resistance zone, nearly at 213, and then we pulled back. We are now sitting just above that critical 205 level. This is the moment right now, today, this week. This is exactly where RTX tells you whether that breakout was real or a fake out. I want to see daily closes consistently above 205. If we get that, the upside on this chart is significant. If price loses 205 on a daily close, especially a weekly close, we're back inside the old resistance zone and the breakout is invalidated. The trend line from September is still intact though, so the rising support is still below price. The setup is still valid, but it needs to prove itself here. All right, so let's bring it all home, folks. Duolingo broke. The $100 level didn't hold, and now we're watching a multi-year support zone around $95. SAP, it's teetering. $200 zone hasn't convincingly held, and 180 is the next real floor. Oklo held the base, but faces massive overhead resistance. And Oracle bounced off the trend line, constructive, but unconfirmed. On the defense side, GD is pressing the upper channel for a third time, and it's at a decision day. NOC's trendline gap remains the most structurally powerful set up on my board, and the pullback is offering exactly the reentry zone I told you about. RTX is holding above the critical $205 level, but it needs more conviction. So this is what real technical analysis looks like in real time, folks. Not a prediction, no guarantees, obviously. This is all probability-based. Levels and confirmations. The market's always going to tell you what it wants to do if you're willing to read it. None of this is financial advice, guys. This is all educational. Do your own research and due diligence, obviously. Know your risk levels. Have a plan before you enter any trade. If this kind of midweek check-in is valuable to you, though, and I think it is, I hope it is, subscribe right now. Share this video and drop it in the comments. Which of these 7 charts are you watching most closely right now and why? It'd be interesting to know.